The global language of business. In today's fast-paced and interconnected world, the language of business transcends borders and cultures, creating a universal platform for communication and collaboration. Written by Thomas R. Robinson, International Financial Statement Analysis is a cornerstone text that delves into the intricacies of financial reporting and analysis on a global scale. It provides invaluable insights for professionals navigating the complex landscape of international finance. In an increasingly interconnected world, businesses operate across borders, engaging in transactions that span continents and time zones. This global reach necessitates a common framework for financial reporting, ensuring that all stakeholders, regardless of their location, can understand and trust the financial information presented to them. Global trade and investment demand a common language for financial reporting. This common language facilitates smoother transactions, reduces misunderstandings, and promotes greater economic integration. It is the backbone of international commerce, enabling businesses to expand their operations and investors to diversify their portfolios with confidence. This is where International Financial Reporting Standards, or IFRS, come into play. IFRS are a set of accounting standards developed by the International Accounting Standards Board, IASB, that aim to bring consistency, transparency, and efficiency to financial reporting across the globe. IFRS are essential for creating a level playing field for companies worldwide. By adhering to these standards, companies can ensure that their financial statements are comparable, reliable, and understandable, regardless of where they are based or where they operate. They provide investors and stakeholders with a clear and consistent view of a company's financial health. This clarity is crucial for making informed investment decisions, assessing risks, and identifying opportunities in the global market. Without a unified set of accounting standards, comparing companies from different countries becomes difficult. Discrepancies in financial reporting can lead to confusion, misinterpretation, and ultimately poor investment choices. Investors face challenges in making informed decisions, hindering capital flows. This lack of clarity can result in reduced investor confidence, increased market volatility, and a higher cost of capital for businesses. IFRS bridges this gap by fostering transparency and trust in financial markets. By providing a standardized approach to financial reporting, IFRS helps to build investor confidence, enhance market stability, and promote economic growth. This harmonization of financial reporting is crucial for the stability and growth of the global economy. As businesses and investors continue to navigate the complexities of the international market, IFRS serves as a vital tool for ensuring that financial information is accurate, comparable, and reliable, paving the way for a more integrated and prosperous global economy. Defining IFRS, a common standard. IFRS refers to a comprehensive set of accounting standards. These standards dictate how companies should prepare and present their financial statements. Developed by the International Accounting Standards Board, or IASB, IFRS aims to create a truly global language for business. The goal is to make financial statements understandable and comparable, regardless of a company's location or industry. IFRS covers a wide range of accounting topics. These include revenue recognition, asset valuation, and disclosure requirements. By adhering to IFRS, companies provide a more accurate and reliable picture of their financial performance. This transparency is essential for building confidence among investors and stakeholders. The genesis of IFRS, from IASC to IASB. The journey of IFRS began with the formation of the International Accounting Standards Committee, or IASC, in 1973. This was a pivotal moment in the history of global finance, as it marked the beginning of a concerted effort to bring consistency and transparency to financial reporting across different countries. The IASC, comprised of professional accounting bodies from various countries, aimed to harmonize accounting standards globally. This diverse group of professionals worked tirelessly to create a set of standards that could be universally accepted, ensuring that financial statements were comparable and reliable, regardless of where a company was based. Over time, the IASC developed International Accounting Standards, or IAS. These standards were the first step towards a unified approach to accounting, providing a common language for financial reporting that could be understood by investors, regulators, and companies alike. These standards laid the groundwork for the more comprehensive IFRS we know today. The IAS provided a solid foundation, but as the global business environment evolved, there was a need for more detailed and flexible standards that could address the complexities of modern financial transactions. In 2001, the IASC transitioned into the International Accounting Standards Board, or IASB. This transition was not just a change in name, but a significant restructuring aimed at enhancing the standard-setting process. The IASB was given a clearer mandate and a more robust framework to develop high-quality accounting standards. The IASB, with its improved structure and broader representation, continues to develop and refine IFRS. The board includes members from various parts of the world, bringing diverse perspectives and expertise to the table. This inclusivity ensures that the standards are not only technically sound, but also practically applicable in different economic contexts. The IASB's commitment to ongoing improvement ensures that IFRS remains relevant and responsive to the evolving needs of global business. By continuously updating and refining the standards, the IASB helps maintain the trust and confidence of investors, regulators, and other stakeholders in the financial reporting process. This ongoing evolution is crucial in a world where financial markets are constantly changing and becoming more interconnected. At the heart of IFRS lie several key principles that guide the preparation of financial statements. These principles ensure that the financial information presented is both reliable and relevant, providing a true and fair view of a company's financial health. One fundamental principle is fair presentation. This principle mandates that financial statements must reflect the true economic reality of the company's financial position and performance. This principle requires companies to present their financial position and performance faithfully, without bias or manipulation. It ensures that the information is complete, neutral, and free from error, providing stakeholders with a clear and accurate picture. Another crucial principle is the accrual basis of accounting. This principle is essential for recognizing the economic events of a company in the period in which they occur, rather than when cash transactions happen. Under this method, companies recognize revenue when earned and expenses when incurred, regardless of cash flow. This approach provides a more accurate reflection of a company's financial performance and position over time. IFRS also emphasizes the importance of comparative information. This principle requires companies to present financial data for the current period alongside data from previous periods. Companies must present financial data for the current period alongside data from previous periods. This allows users of financial statements to track trends and assess a company's performance over time, making it easier to identify patterns and make informed decisions. This allows users of financial statements to track trends and assess a company's performance over time. By comparing financial data across different periods, stakeholders can better understand the company's growth, profitability, and financial stability. The principle of materiality is another key aspect of IFRS. This principle ensures that all significant information is disclosed in the financial statements. Companies are required to disclose all information that could reasonably be expected to influence the decisions of investors and creditors. This includes any information that could affect the economic decisions of users, ensuring transparency and accountability in financial reporting. The adoption of IFRS has significantly impacted global business. One of the most notable benefits is increased transparency. By adhering to a single set of high-quality accounting standards, companies provide investors and stakeholders with a clearer understanding of their financial health. This transparency fosters trust and confidence in the global marketplace. Another crucial impact of IFRS is enhanced comparability. With a common accounting language, investors can easily compare the financial performance of companies from different countries. This comparability facilitates cross-border investment and promotes the efficient allocation of capital worldwide. IFRS also simplifies the process of consolidating financial statements for multinational corporations. This streamlined reporting reduces costs and improves the efficiency of global business operations. While the benefits of IFRS are undeniable, transitioning to these standards can present challenges for companies. Implementing IFRS often requires significant changes to existing accounting systems, processes, and internal controls. Training staff on the intricacies of IFRS and ensuring compliance with its requirements can be resource-intensive. Despite these challenges, the long-term benefits of IFRS far outweigh the initial costs. Companies that adopt IFRS gain access to a wider pool of investors as their financial statements become more understandable and trustworthy. Improved transparency can also lead to a lower cost of capital, as investors are more willing to invest in companies with reliable financial reporting. In conclusion, IFRS has become an indispensable element of the global financial system. As cross-border trade and investment continue to grow, the role of IFRS in promoting transparency, comparability, and trust will only become more critical. The IASB remains committed to evolving IFRS, ensuring its continued relevance in a constantly changing world. The future of IFRS will likely involve addressing emerging issues such as sustainability reporting and the rise of digital assets. By staying ahead of the curve, IFRS will continue to foster stability, efficiency, and confidence in the global marketplace.